The tariffs themselves will probably cause a little pop up in inflation, a little temporary pop up, and then inflation will continue to do what actually it's been doing for the last couple of years. It'll come down. And the reason for that is that inflation is always and everywhere a monetary phenomenon. And the money supply for the last 2.5, 3 years has been very anemic. Even now, its growth is only about 4.5% per annum. And Hanke's golden growth rate for the money supply, a rate consistent with hitting the Fed's inflation target at 2%, is a little over 6%. So the money supply has been growing very slowly for quite some time, and usually with a lag that works into a slowdown in inflation. But there might be a little temporary blip up because of these. Another thing, sometimes, and that will increase the price level once. It'll jump up. And that's the most similar to what's going on with the tariffs, because the tariffs are a sales tax on Americans. That's all that's happening. I mean, the Trump's smoke and mirrors coming out of Washington is that foreigners pay for the tariffs. No, Americans pay, because the person who imports the goods from foreign countries is the one who pays. It isn't the one who exports the goods that pay. It's Americans that paid. So we're going to have one of the biggest tax increases we've ever had in the United States because of the tariffs. And that increased sales tax on Americans will pop up the consumer price index once, and then the CPI will start trending in a way that's consistent with what's been happening to the money supply a couple years ago. And what was happening a couple years ago is the money supply is anemic and shrinking. So that means that the trend, once the pop-up occurs, then the trend will set in again and inflation will start coming down. For some time, due to the fact that we've had this anemic growth in the money supply, we know when that happens, it will cause the economy to slow down. So I've been predicting a slowdown. And although the second quarter GDP number came in at 3%, and Trump was saying, we're in a Trump boom, everything's going well, he forgot to tell us that there was essentially no growth in the first quarter of the year. So if you look at the first half of the year, it's growing a lot more slowly than it was in 2024. Exactly what I've been predicting. We're slowing down. And I think there's a very good chance we're going to end up having a recession as a result of this slowdown. And that slowdown caused by anemic money supply growth. Then you add the Trump into the picture, and Trump creates what's called regime uncertainty. He's changing everything all at once. And once you start changing everything all at once, you get business people like you say, hey, I'm going to wait and see where the dust settles on this thing before I do anything. And the last time we had this kind of situation was with Franklin Delano Roosevelt and the New Deal in the 1930s. And the New Dealers, they were like Trump. They were changing everything. They even engaged in outright theft because they revoked the gold clauses in contracts in the United States. And it became illegal to hold gold in the United States. So they were changing everything. You had a lot of regime uncertainty. And what was the result? The result was from 1929 to the start of World War II, there was no investment in the U.S. It was zero. And what happened? The Great Depression was a lot deeper and lasted a lot longer than it would have if we hadn't had the wonderful New Dealers. You read about this in history books, the New Dealers, how great they were. They saved Americans. No, it was just the opposite. They were a complete disaster. They created huge regime uncertainty and made things a lot worse than would have been the case if they hadn't been around. Well, I don't think that people should be focusing on interest rates, number one, that are controlled by the Fed, meaning the overnight interest rate is the Fed funds rate. That's something the Fed controls. And that is the wrong thing to be looking at. Both Trump and Chairman Powell have the thing completely wrong. Most of the financial markets do, of course, the financial press. Monetary policy and the stance of monetary policy is not given by interest rates, the Fed funds rate. It's given by changing changes in the money supply. So the question is, what are you going to do with the money supply? Where is the money supply? And the money supply, as I said, is growing at a very slow rate, 4.5%. Credit creation by banks also is growing at only 4.5%. And we have to get the money supply growing a little more rapidly. Now, how do you do that? Well, it isn't the Fed funds rate. You stop quantitative tightening. The Fed now is engaged in a tightening policy, but they call it quantitative tightening, shrinking the balance sheet of the Fed. That's one thing. The other thing, and this is something that Matt Sikirky and I get into in great detail, is bank regulations. Because banks create most of the money supply, about 80% actually, broad money in the United States. It's not produced by the Fed. It's produced by commercial banks when they extend credit to you or me or whoever is receiving the credit. So the bank regulations right now, there's one reserve requirement that came in at the time of the great financial crisis, and it's called a supplemental liquidity reserve. And that does constrain banks. It reduces their capacity to make loans, basically. Fortunately, the Fed actually is talking about taking that off, that supplemental liquidity reserve requirement. So those are the two ways that you could loosen up. There are other ways you could loosen up too. But the Fed funds interest rate, this obsession with the interest rate is just the wrong way to go. The reserve requirement, it's very cumbersome and constraining for banks because they have to hold the same amount of reserves on assets that are U.S. Treasury bonds and bills, for example, than they do for other kinds of, commercial loans, mortgages, things like that. So it requires them to hold really way too much in terms of reserves. They don't have as much firepower, let's put it that way. The way it works, number one, the banks aren't engaged in borrowing much with the overnight Fed funds rate. That's a very short-term thing. So the big problem is if you lowered the federal funds rate by 3 percentage points, which Trump is arguing they should do, what that would do, it would increase the long-term interest rates that are determined in the marketplace, like the 10-year bond and mortgages, the rates would go up. So you'd be facing a stronger headwind. I guarantee you, if they reduce the Fed funds rate by 3 percentage points right now, mortgage rates would go up, not down. And long-term lending rates would go up. The yield curve would get a lot steeper. And the reason for that would be that inflation expectations would get unanchored. People would say, oh, God, they're going to flood the place with money and inflation's going to come back and things like that. So the mechanics of what you went through, it doesn't work that way because the interest rate that people face in the real world, it isn't the Fed funds rate. It's the rates for loans of the duration that they're taking out in the marketplace. And I can guarantee you, his suggestion, if followed, at lowering the Fed funds rate by 3 percentage points would increase the interest rate on 10-year bonds and increase mortgage rates. It would completely backfire. What he's talking about is nonsense, basically. To prove this, he makes a calculation, Trump does. He said, if they lowered the Fed funds rate by 3 percentage points, it would save billions of dollars for the federal government in terms of interest cost on, credit that they have to receive to finance a fiscal deficit. But the problem is the government doesn't borrow at the Fed funds rate. That's an overnight rate. Even Treasury bills are much longer dated than the Fed funds rate. The average duration of the debt in the United States is 6.5 years. So they're borrowing on average at that rate, not the overnight rate. So it's all smoke and mirrors, what Trump is talking about. He doesn't even have his arithmetic right. The idea of growing out of all these problems, I think, is a little bit, and the AI hype, there's a lot of hype indicating that we're going to somehow grow a lot faster, and that will eliminate all these debt problems, or at least mitigate the problems associated with too much debt. So my take on that is that the growth potential in the United States is running a little over 2%. That's the long run kind of sustainable growth rate. And even the more optimistic, realistic assumptions about AI is that AI might increase that a little bit. Maybe we go from 2.2 to 2.3 or 2.35. So nothing really changes that much. It's not this revolutionary thing that's being hyped in the press. Even if you work the numbers out on the most optimistic scenarios, it moves the needle a little bit, not very much. So we're basically in the soup that we've been discussing earlier, no matter what. So in short, don't hold your breath that we're going to be rescued by AI. Over the long term, wage growth usually shadows changes in labor productivity. So it depends on what happens with labor productivity. If labor productivity continues to go up like it is, wages will go up like they've been going up. And there are cyclical things that happen. For example, during COVID, the average real wage didn't go up as fast as inflation. So people were on wages really getting squeezed big time. The people who made out during COVID and the increase in the money supply, increase in inflation, that increased asset prices. So people who owned assets, rich people, made out very well. And one stunning number is the fact that billionaires' wealth as a percent of GDP in January of 2020, right before COVID, it was 14.1% of GDP. Now it's 21.7% of GDP. So the billionaires were made out like bandits with this huge inflation because the inflation happened where? Housing, real estate? Real estate went up. Land prices went up. The stock market went up. And who owns all this stuff? Well, rich people do. The middle class and certainly the lower class, they have balance sheets that are in deficit. They owe more debt than the assets that they own.